Wall Street is roaring after Trump hit the brakes on new tariffs. But is this rally legit, or are we being set up for a market trap? Before you buy the dip or ride the wave, let's decode what this move really means for your portfolio. Hey, I'm Robert, and welcome to The Alternative Investor. Today, we're diving into a major policy twist that just rocked the markets. President Trump's surprise decision to pause his planned tariffs for 90 days. Stocks jumped, headlines screamed optimism, but underneath the surface there are serious implications for investors. We're breaking down who wins, who loses, and how to position your money before this 90-day window slams shut. President Trump recently announced a temporary suspension of planned tariffs targeting hundreds of billions in goods, primarily imports from China, the EU, and parts of Latin America. This includes automotive components, electronics, metals, and key industrial inputs. The 90-day pause appears to be a strategic delay, rather than a full reversal. It's being framed as a window to renegotiate trade deals, avoid escalation, and ease inflationary pressure ahead of the 2025 election cycle. But what really turned heads was how quickly the market reacted. On the day of the announcement, the Dow Jones surged over 300 points. The S&P 500 hit a 4-week high. The Nasdaq climbed nearly 2%, led by tech giants with global supply chains. Investors celebrated the pause, but the speed and scale of the rally raised eyebrows. Let's talk winners, because the market didn't rise evenly. First, automotive stocks, Ford, GM, and Tesla all saw gains. Why? Because tariff relief on imported parts lowers production costs and stabilizes supply chains. Global automakers with operations in Asia and Europe are also breathing easier. Next, the technology sector companies like Apple, Nvidia, AMD, and Intel depend on manufacturing and materials from overseas. The tariff pause reduces the risk of price shocks and supply chain slowdowns, giving them room to rally. Now, retail and logistics major retailers like Walmart and Target saw a bump since they import massive amounts of goods from China. FedEx and UPS also gained as shipping becomes less cost-constrained during the pause. Lastly, industrials Caterpillar, Boeing, and 3M all moved higher as input costs and global contracts became less risky in the short term. This ripple effect hit nearly every corner of the market, but not all of it is rooted in fundamentals. Much of the movement is speculative, and that's important to remember. Now let's flip the coin. While the pause triggered a surge, not everyone is celebrating. Leading banks and analysts are waving red flags. JP Morgan's analysts warned that this could be a classic relief rally with no real long-term resolution. They believe the pause is more political than economic. Goldman Sachs called the move transitory, warning that unless trade negotiations yield concrete changes, markets could face a sharp pullback. Even more concerning is the potential for insider trading. Several watchdog groups are investigating whether well-timed trades were placed by individuals with early access to the announcement. This adds a layer of regulatory risk and could undermine trust in the rally's legitimacy. On top of that, inflation hasn't disappeared. While the pause may slightly ease costs, core inflation remains sticky. If talks stall or tariffs resume after 90 days, this entire rally could unravel. So, how do you navigate this? 1. Don't chase the hype. If you didn't buy before the announcement, be cautious. Chasing momentum rarely ends well. Focus on companies that are fundamentally strong, not just riding headlines. 2. Rebalance into strategic sectors. Consider tech and industrials that benefit from eased trade tensions, but with strong domestic demand and cash flow to weather uncertainty. 3. Watch the timeline closely. This is a 90-day window. If trade deals don't materialize, tariffs could return with a vengeance, and that means a potential market correction. 4. Use the rally as a strategic exit or entry point. If you've got gains from this surge, this could be a smart time to lock in profits or reposition into safer assets as volatility likely increases heading into Q3 and Q4. 5. Stay informed, not emotional. This move is as much about psychology and politics as it is about economics. Don't let short-term rallies cloud your long-term investment plan. With all this volatility injected into the market, this might actually be the perfect time to make the chaos work for you. Especially if you're an options trader or looking to generate passive income with lower risk. Selling covered calls? If you're holding stocks that just rallied, especially in sectors like tech, industrials, or retail, this may be a prime time to sell covered calls. With implied volatility elevated, option premiums are richer than usual. That means you can get paid more for agreeing to sell your shares at a higher strike price. It's a way to generate income on stocks you already own, without necessarily losing them unless the price continues upward past the strike. Selling cash-secured puts. On the flip side, if you're looking to buy into this rally carefully, cash-secured puts are a smart way to do it. You get paid to wait, and if the market dips or corrects, you may get to buy shares at a discounted price, one you already agreed to and were comfortable with. If the stock stays above the strike, you keep the premium and try again. Bottom line, whether you're sitting on gains or still waiting to enter the market, option strategies like these allow you to turn short-term uncertainty into income. It's not about predicting the market, it's about positioning yourself so you win either way. This 90-day pause on tariffs may have lit a fire under the market, but whether it's a spark or a flare-out remains to be seen. As always, staying one step ahead means cutting through the noise and seeing the big picture. If you found this breakdown helpful, give it a thumbs up, subscribe to The Alternative Investor, and drop your take in the comments. Do you think this rally is sustainable, or is it setting up for a crash? I'm Robert, and I'll see you in the next one.